Ever wondered how the stock market works and what the recent buzz is all about? Well, it's a fascinating world where companies and investors come together. Companies issue stock to raise money for growth and development, and investors buy these stocks, becoming part owners of the company. Now, the value of those stocks can rise and fall based on a myriad of factors, creating a bustling marketplace of buying and selling. Recently, there's been a lot of chatter around meme stocks like AMC, Bed Bath & Amp, Beyond, and GameStop. These are stocks that have seen significant gains, not necessarily based on the company's performance, but largely due to a surge of interest from retail investors. We've also seen a rise in speculative investments in cryptocurrencies, with shares of platforms like Coinbase skyrocketing. The stock market is a complex system, influenced by everything from economic indicators to investor sentiment. And while it can be a place of great opportunity, it's not without its risks. As we dive deeper, let's remember that the stock market can be as thrilling as a roller coaster ride. The current state of the stock market is a mixed bag of events. The small-cap Russell 2000 index, a key player in the stock market, is teetering on the edge of bear market territory. Its decline has been a point of interest for many, especially since it started its downward journey on November 8th. Meanwhile, the S&P 500, like a rebellious teen, decided to go in the opposite direction, hitting a record high on January 3rd. Talk about a plot twist. This tale of two indices has led some market strategists to believe that we might be nearing the bottom of the recent sell-off. Despite the Russell Index being down 18% from its record close, and the S&P 500 trailing behind with a 9% drop, some see this as an opportunity rather than a setback. With the average small-cap stock down about 40% from its 52-week high, valuations have become more attractive, and earnings are holding up. It's like a clearance sale at your favorite store. Everything must go. The forward price-to-earnings ratio for the Russell 2000 has dropped to 22.1 from 28.1 in November. This drop has some investors rubbing their hands together, eyeing the potential for buying opportunities. But just as every rose has its thorns, every opportunity has its risks. The specter of rate hikes, inflation, and the Federal Reserve's monetary policy loom large, casting long shadows over the market. The Federal Reserve is due to release a statement following its two-day policy meeting, and let's just say, the anticipation is palpable. In summary, while there's a glimmer of optimism that we may be close to a bottom, many investors continue to tread carefully, aware that the sell-off may have further to go. After all, the stock market is like a game of chess. You need to make your moves wisely. Curious about the future of the stock market and how you can get involved? Let's take a journey into the not-so-distant future. Reuters polls suggest a moderate rally in global stocks, implying that the world's economies are recovering, evolving, and growing. Wall Street isn't being left behind either, with expected gains, making it a potential hotspot for investment. However, as with any investment, there are risks. The US rates and the Omicron variant pose potential challenges. But don't let this deter you. Remember, risk and reward often walk hand in hand in the world of investing. Now, how do you get a piece of this pie? It starts with opening a brokerage account. This is your gateway to the stock market. Then comes the homework. Researching stocks may seem like a daunting task, but it's necessary. Look into company performance, industry trends, and financial reports. Once you've done your research, make an investment plan. How much are you willing to invest? What's your risk tolerance? How long do you plan to keep your money in the market? These are all crucial questions to answer before diving in. And remember, investing is not a get-rich-quick scheme. It's a journey that requires patience, resilience, and constant learning. But with the right approach, it can lead to financial growth and stability. Getting involved in the stock market might seem daunting, but with careful planning, it can be a rewarding venture. Wondering how much you can potentially earn from the stock market? Well, let's dive into the earnings game. The potential earnings from the stock market can be quite substantial. However, these earnings are influenced by several factors such as market volatility, the amount you invest, and your investment strategy. Market volatility refers to the rate at which the price of a security increases or decreases for a set of returns. It is a measure of risk and uncertainty. In a volatile market, the potential for big gains goes hand in hand with the potential for big losses. So always remember, higher the risk, higher the potential returns. The amount you invest also plays a significant role. A larger investment can mean bigger returns, but it also means more exposure to risk. So, it's crucial to invest an amount you are comfortable with potentially losing because the stock market is unpredictable and there are no guaranteed returns. Your investment strategy is another determining factor. Are you a long-term investor who's looking for steady growth over several years? Or are you a day trader seeking quick profits from short-term price fluctuations? Each strategy has its own potential earnings, risks, and requires a different level of involvement and knowledge. Now, let's talk about the average return rate of the stock market. Historically, the average annual return of the S&P 500, which is considered representative of the US stock market, has been around 7 to 10% after adjusting for inflation. However, this figure fluctuates from year to year, and past performance is not a guarantee of future results. While the stock market can provide substantial earnings, remember, it's not a get-rich-quick scheme. Patience and strategy are key.